So the topic of today's episode is FAQs, or frequently asked questions in Treasury. And for the past several years now, we have been asking respondents to some of our industry surveys to submit questions that they have about the Treasury space, be it regarding technology, operational issues, or some other area. And at this point in time, we've gathered hundreds of responses, and although we don't have time to cover every single question we've received, I do have a list in front of me today with some of the most frequently asked questions that have been submitted, and our intent is to go through this list one by one. Craig, I will read the question to you. You can answer it as best as you can. I'll slide back in with some follow-up questions or commentary, and then we'll just move on to the next area. So to begin, right off the bat, why are Treasury management systems not as strong as Excel when it comes to cash forecasting?
That question has some assumptions behind it. So I guess I would say Treasury management systems are particularly good in some areas, and Excel is superior in others. And I think when we think of Excel is great for free-form modeling, very quick to create a new scenario. And when you think about forecasting, I can enter other inputs, I can connect to other tables or databases, and make my forecasts. So it's really quick to do modeling. And when you think about forecasting, modeling is a big part. It doesn't occur all the time, but it's really easy to do that. And it's very easy to look and make changes. I want to increase last year by a certain percentage, or I want to look for periodicity or other elements of it. I can graph it. I know how to use it. That's why it's very, very popular for forecasting, and it tends to be superior in many of those ways for most companies. Now, on the treasury management side, they're not inferior in forecasting. There's some areas where they're extremely capable. One is they get all the data in them for what your actuals are. At least actuals as they flow through the banking statement. So the information comes in, it's there. They vary in their ability to generate different types of forecasts, either based upon historical information or doing models. So some of them are good at capturing the one-off information, tax enter something. You can make it available for them to put in there. But where they excel, maybe I shouldn't use the word excel if we're comparing it to Excel, is in doing variance analysis. So when you look at your flows, you're projecting your flows by account or bank, et cetera, it can quickly identify variances by amount, by size, by whatever that level is, and you can drill down to what was my forecast and what the actuals were, which is a crucial part of improving your forecast.
So, and over the past several years, we have seen a lot more capabilities being input into Treasury management systems, especially in the area of forecasting, and yet we continue to see many practitioners voicing either skepticism or general dislike for those functionalities. Do you think that's more on the part of treasurers not being adequately trained on how to use the technology, or do you still see that as just having farther to go before more treasurers sort of deviate from Excel into a TMS?
Sure. So, when you think about the continuum of very small companies that are doing a forecast, they maybe they're using QuickBooks or Great Plains. They have most of the data in an accounting system. They can look at their cash flow from a simple report. That may be perfectly adequate. As they get a little bit larger, Excel may be a great tool for modeling those and looking and tracking and creating reports that look good that they can distribute. When you get to larger companies, the satisfaction with the forecasting systems can vary a lot. And that there's a couple sources of that. One is some systems are really good at forecasting, and they continue to get better. They take the feedback, and so they're highly capable. And the companies that are very good at leveraging that technology by using it properly, getting data to come in, running their different models, tracking it, doing their variance analysis, using that as a feedback loop, tend to be pretty happy with what's going on because it's very efficient. Others that are thinking that this is the magic tool that will simply determine what goes on tend to be disappointed. They don't do the work of talking to people for the one-off items, or capturing that or providing the incentives for another area to make sure their forecast feedback or input is accurate. Another reason why people aren't as satisfied with their treasury management system is they don't think about it from a complete technology stack perspective. And what I mean by that, I don't mean what your IT person says is the technology stack. They need to think about data, how they're going to connect, and then the system, which will be the treasury management system. People need to consider where is the data that's going to be most efficient and useful into the treasury system. That could be an APAR, it could be legal, or payroll passing data. It might be a feed from a particular system. And if you don't think about where this data is, then you're going to have problems, because you may only be relying on historical data, and that works fine for some cash flows, but other times it's not going to be accurate at all, and you need other inputs, other variables. Your distribution may be 50% larger than last year and 30% larger in volume because of certain factors. If you don't do the work of saying, where's my data, how do I get that, you're going to have a problem. And some of the data isn't in systems, it's in people's heads. They're planning, they're doing things, and that has to be fed back into the loop. So that's another piece. It's making sure you think about where the data is, what you need. And the human element for some companies is extraordinarily important, and it can be overlooked. We're not an island unto ourselves. All of the data doesn't come through the bank statement in the way you want. Some of it's in the financial systems, some of it is in people's heads.
So to summarize, treasury management systems are not necessarily weaker than Excel. In fact, in a lot of situations, they are stronger, but for smaller companies, maybe Excel a more reasonable approach until complexity increases. But for those companies that are large enough to use a treasury management system, there is forecasting functionality available that can provide benefits over just standard spreadsheets.
I think that's a fair way to put it. I would also add that for many companies, once they reach $1 billion or more of sales or annual turnover, that they're going to use a combination of Excel and their treasury management system. Excel is great for running models, and if you're creating different models, that may be the best way to do it. You push it into your treasury management system as the new model or as a second new model, and you can run and back test that and see how it goes on. It's hard to create models as quickly as you can in Excel, but it's also very hard to do variance analysis and track and see how those go outside of the TMS.
Sure. All right. So moving on now, second question that we have here. What is PSD2, and does it have any impact on banking in the United States?
PSD2, or Payment Services Directive 2, is the second directive, and it's not a law. But it carries essentially the same weight for banking institutions. It's a directive. You need to follow this. The regulators have it, and have pushed it forward. So PSD2 is the requirement for the banks to expose some of their data and information and some processes via APIs, or application programming interfaces. So these programs that call data. And when we think about that, that's pretty neat, because, and I use the term neat because development on the banking side is slow in some ways. And it's slow because they have to have systems that work. There's a number of massive systems that are well controlled, and it goes from one system to another, and they have dozens and hundreds of systems. That data it gets exposed to their corporate clients through a portal or through a feed. Now, it's not easy to get to that data, and because the normal process is they push it to some kind of communication hub, make it available to an FTP through Swift, et cetera. Now, it takes a lot to change those, and the reason it's so stable and it's so hard is that they have to make this work. Now, making changes so that everything would be exposed to the latest technology instantaneously can't necessarily mean you have to throw out all of your infrastructure. It would take years to replace hundreds of systems and make it work. So naturally, to get at that data, you have to create a method of having some sort of front end that can be called with an API. And that's what PSD2 says. I mean, it's the main focus of it is you need to expose your data so there can be additional development, creative innovation, so that other tools and software could perform these functions, rather than say, I have to create an FTP file to extract certain data to load it into a system, and I have many, many steps. Here's something that I want to pull up the bank balance or see who's a signer on an account. I can create an API that calls and gets the data back in a very secure manner, but it's very particular and specific at what it can do.
So simply to streamline bank communication with corporate systems, being able to pull bank statements, retrieve information on transactions and such in a manner that doesn't require manual intervention and a lot of additional steps.
Yeah, and a lot of care and feeding. So it takes some of that out. And when we think about the development, if you put some tool and you say, hey, I want to pull balances in, and I want to use an API, I just want to pull balances in, and I can leverage an API, well, my setup time is going to be vastly faster. And since it's so much faster, I can do other development. Now I've created a portal or a dashboard that can show my balances very easily, or I can do extra checking. So their directive meant to encourage this type of innovation and allow different types of software providers or technology providers to access that is excellent. And it's having an impact in Europe in particular, but that is also flowing over into North America, into the United States. That was the second part of your question.
Right. So yes, and to get to that now, I know that the PSD2 was originally released in Europe and was said to have an impact there over the next several years, but people are wondering, do you see the impact spreading to other parts of the globe, and how long do you think it will take before that impact is felt in the same manner that it is being in Europe?
In the same manner, I think that might take just a few more years, but I would say the impact is global. It's more in Europe than U.S., but you think about nobody's living in isolation now. All this information is shared. They're going to a SWIFT conference like Sibos. They're sharing information through the internet all the time about what's being developed. Banks are supporting customers across the globe, and may have a presence in Europe. A U.S. bank or a Canadian bank may have a presence there, and they have to support PSD2. Since they're creating that, they want to expose that type of capability to all their customers. So everyone knows it's happening, and there's some interesting developments there. So it is having a pretty big global impact because of the directive in a particular region. So exactly how it will manifest itself in terms of, U.S. versus Europe, I'm not sure when there'll be the equivalent impact, but we hear bankers in North America talking all the time now about the APIs, using APIs to do certain functions. So they're building the front end or the part of the system that can be exposed to support those calls or the API activity.
Sure. So PSD2, definitely something to be on the lookout for over the next several years, especially if you are a client or a corporate that experiences problems with bank connectivity at the moment.
Well, the other thing too, Isaac, on that is because it's an easy way to pull certain bits of information in, it might be much easier to pull smaller banks or other banks. So we see things like our Treasury aggregators, those that are gathering bank data and information and making payments. They're building that functionality, just like they can do host-to-host through FTP or other protocols. They can connect to SWIFT and other networks. They can use other types of connectivity like API. So they're adding that to to their complete offering.
Okay, thanks, Greg. Moving on to our third question, and this is another two-pronged question. Is EBAM, so electronic bank account management, still a growing trend? And what will it take for EBAM to become more mainstream?
One part of the answer is that it's growing slowly. But I think that's easy to dismiss it. So let me give you my thoughts on bank account management and what it will take for EBAM to take off, and why that's useful, but maybe not as important as overall bank account management. So, I think, one aspect of EBAM is electronic bank account management, the ability to send all these forms to set up new accounts or to add signers or add services in the form of these messages back and forth to the bank digitally, right? So this back and forth conversation can occur through messages. That requires what? It requires the bank able to receive those and process them on the back end. It requires the corporation to have all of their bank information set up and accurate in a system, and that system to have the ability to handle the processes and these conversations. Now, with that said, there's two challenges in terms of where the bank account management process is in companies and what's going on at banks in terms of integration into the back end. Let me start with corporations. So corporations have gotten better at managing their bank accounts through systems, and some of those systems can support EBAM. But if you don't have everything of all your bank accounts in a single database managed efficiently. All the signers are there. You're using that for, maybe your output is a printed report now or an EBAM message or conversation. If you don't have that, you can't really use it or leverage it to the full extent. So you have to have efficient bank account management in order to make that work. Corporations are getting a lot better at that over the past, at least 4 or 5 years. EBAM didn't trigger people to do that. Regulations like FBAR, Foreign Bank Account Reporting in the U.S., is one area that's had an impact, because when you have to start doing reporting, you're like, I don't have all the signers. They're not kept up to date. We don't have our services in there. So they're starting to be more formal. The other aspect that's helping that is Treasury management systems have been adding very healthy bank account management functionality that is, increasingly approaching what's offered by the dedicated bank account management systems. So that's the corporate side. Now, on the bank side, there's a challenge too. You can, a bank can say, hey, I'm accepting this particular message or conversation, and what's happening is it's being resolved by, there's a printout. Someone takes that printout and enters it into another system. Well, it's pretty involved for banks to, be able to exchange these conversations and update all of their back-end systems. So that's why I say slowly. There is progress. It's not going to stop. So the biggest issues are banks filling out the completion of these systems, making it end-to-end on the back end so that they're not dropping from a fully automated system or straight-through process system to a straight-through to print to rekey to make sure it's not in error. And then the corporation side is fixing the bank account management mess that many, many have.
And to touch on another item here, you say EBAM is growing slowly. Slowly is perspective. You can, it may be faster for some than to others, but one of the big items here is that compared to other challenges or complexities that Treasury is facing, EBAM is probably not at the top of their priority list. There are other factors to consider, whether it be security elements or efficiencies related to payments that will come on top. And with a limited budget, Treasury may have to pick and choose what initiatives to pursue, and EBAM is just getting pushed down the list as more important items come to the top.
Yeah, EBAM should not drive what you do in Treasury. Having effective control of your bank accounts should, and then some of the systems that have that, you should make sure that they can incorporate this type of capability so you have end-to-end processing from the corporation to your bank. So that's where the promise is, of course.
Sure.
Yeah.
Thank you for clarifying that. All right, moving to the fourth question. This is something that a lot of respondents in North America specifically have asked us over the past 2 or 3 years, and it is, what will it take for checks to disappear altogether from the payments landscape?
I think an answer to prayer. I think about checks are terrible, and they're just inefficient. Not only do they give paper cuts, but they're just costly. So little tongue in cheek there. Nobody wants to get behind somebody at the grocery store where someone pulls out a checkbook. That used to happen a lot more. Now it's pretty rare where someone pulls that out in front of you. ACH, in some of our surveys, we've seen ACH come up so far ahead of checks in terms of people's preferred method of paying and receiving on the corporate side, B2B side, et cetera. It's still easy to do. Every system can print checks. It's like, this is great. We can print checks, mail them, have them go through so we have this float. So I think a couple things is we have to have some impatience and a sense of urgency. So we need to stopping at 80% when we're trying to convert things to electronic. Don't go to a certain point and say, hey, we achieved 80% of converting things to electronic. Push it all the way. Make sure that it goes all the way through. There probably needs to be some regulation changes as well, because some of that stops people from going to ACH or using things like pay cards. Some checks or some states in the U.S. Provide regulations that says that say you have to offer checks to employees. You can offer ACH, you can offer pay cards. Well, they quickly put in place is like, no, you have to offer checks. As if that's particularly useful. Now, having some flexibility, pay cards or some other method of paying is useful, but I think there has to be a concerted, persistent effort to eliminate checks as much as possible over time. It's going to be a long time. I'm not going to say when it might end. We've been in a long period now of less checks, getting to checklists. that's a continued problem.
And I think one of the things we've seen, especially over the past several decades, is instead of eliminating checks entirely, we have seen new methods introduced of how to optimize or streamline the use of checks, rather, whether it be through RDC, remote deposit capture, or other mechanisms. So it may not even be that checks are being eliminated, it's just that their use is being optimized.
Yeah, so converting, stopping altering a disbursement process that's creating a check to making it ACH at the start or some other method is obviously the number one choice. But when checks escape whoever's issuing the payment and it moves to the process, that idea of truncating them or converting them to an ACH from the check to create an ACH instrument, or either at a lockbox or over the counter, or this concept of taking an image of that and then routing the image through electronically eliminates some of the worst parts of a check moving through the system. So those are helpful ways we're stopping this ongoing check nonsense.
Sure. So we will not put a timetable on when will checks disappear, but something to look at in the coming years as new payment options are introduced and as checks are gradually eliminated from the landscape. So moving to our fifth question, and this is a technology-related question. How do ERP Treasury modules compare to TMS solutions?
This is one that will get people angry if I answer it, no matter how I answer it.
Tread carefully.
I don't really mind how people view it. I think, when you think about ERP systems, they're designed primarily for accounting purposes, and then for some of the financial processes of the cash conversion cycle, ordering, getting resources, etc. So they're designed for that. They're designed for financial reporting. By nature, they are good at making sure the process is consistent, that the financial system will provide accurate records, and it's historical. What's happened? When did something become a work in process? When did it move through the system? Ultimately, to when things were paid. But by and large, those systems are historically looking. They're backward looking. They're looking at past and history to making sure they have the right controls. Treasury systems are geared primarily looking forward. What is our cash position today? That's a zero-day forecast. What is our forecast in the future? What are our concerns about counterparties in the future? What scenarios should we run for, what happens with FX or our cost of commodities? Those are future-oriented items. So when you look at these two type of platforms, it's the orientation is very different. Now, you can say financial data is financial data, and they use some of the same things. I mean, accounting systems look forward. There's a forecast that might be income statement oriented. Treasury systems have to look back at history. But the general orientation is where the biggest difference is. And the second has to do with the risk orientation. Now, ERP systems have been adding more risk functionality. But when you think about cash flow at risk, for example, or you think about other elements of different exposures to, maybe your underlying principal, at risk, Treasury and Treasury systems are geared towards, visibility today and into the future, and be able to understand models and how one item may influence another. So it's more modeling, more projections, more risk-oriented than an accounting system. So that's where you see the difference, and it's pretty significant. So for some organizations, smaller organizations, they have an accounting system, maybe not an ERP. That's going to be adequate, and they can do something in Excel. When you start to get to large organizations that have a lot of risk, a lot of modeling, a lot of cash flow, a lot of forecasting, it gets very hard to do all of that in the ERP systems, or to do it as well as the TMS. Now, the argument, this argument happens a lot, where you say a comprehensive solution, like the ERP says, hey, it's a single solution, and they will talk about different systems for, shipping or treasury or whatever. They'll call them point solutions. Say, hey, they only do one thing. Ours is an integrated, comprehensive solution. And so that's usually the argument made from the ERP side. And treasury systems make that same argument when they say, hey, we can replace this other FX trading platform and this data provider, et cetera, et cetera. Now we can combine them into a single system so that you can see and manage your exposures properly. There's substantially better cases to be made for Treasury systems to become more comprehensive or integrated in the areas that Treasury is looking at, which tends to be looking forward. On the, I can certainly appreciate IT saying, let's use a single system. We don't need all these other systems we have to support. It's a single system. We have people experienced with ERP number 1 or number 2 or number 3, and I don't have to support all those things. But they tend to be very slow to adapt to what Treasury's needs are. And Treasury's needs are changing rapidly. A new situation comes up. They have to be able to respond more quickly. Accounting systems have to reflect IFRS or GAAP. There's usually multiple years before these things become, enacted, and you have to follow them. A long adoption period. And so they have a long time to have those changes made, get the updates, and then put them into their process. Treasury doesn't have that same time luxury. They have to move much more quickly. So I think those are some of the key reasons why Treasury systems do so well, because of the orientation differences.
And I think you have touched on the main point there, simply that TMS solution is specialized for Treasury in specific, whereas an ERP has a bit of a broader reach and is oriented towards accounting. But as we look at the sophistication and the capabilities of ERP Treasury modules, have you seen them gain ground on a TMS solution over the past several years? And do you foresee them sort of coming more into that Treasury space harder? Or do you believe that the gap that exists currently will continue to exist moving forward?
You can measure it different ways. They've gained ground in that someone has SAP or Oracle, PeopleSoft. They have, if they implement a Treasury side, usually it's driven from IT. IT's pushing it for single vendor purposes. Once you implement it, they're not usually yanking it out, except when it doesn't work. And usually they'll spend a lot of money to make it work. Now, we have seen lots of examples where people have said, shut that down. We're going to use a system that works. We need to do these things. But it's hard to pull them out because now it's just part of the whole process. I think that's a key reason. But I think the other thing that's helped is Treasury systems used to be much more difficult to manage and implement. So as ERP systems got easier, there was more of a push there. Now Treasury systems have gotten much easier, much more capable, and the value of those systems increases year after year rather than decreases as you lose capability. So they continue to add functionality to them and ease of use, process control. So they've gotten much more valuable. So we have seen an uptick, a significant uptick in Treasury, and particularly in Treasury management systems. So I would say those have been growing faster, significantly faster than the implementation of ERP TMS elements.
Thanks for your input there. Moving on to our final question of the day, and this is focused on one of the new disruptive technologies we have seen over the past several years. This is also forward-looking. The question goes, do you think blockchain will be a standard Treasury tool within the next decade?
I mean, I'm not sure what to make of that question when we hear it as a standard Treasury tool. I think that the person who's asking that is thinking of it in terms of, is this going to be used with regularity? Blockchain or distributed ledger technology, DLT, where instead of having a single person who verifies a transaction who's a trusted party, there's multiple people who are trusted parties. Sometimes people use Bitcoin as synonymous with blockchain. Bitcoin and some of the other ones, Litecoin, et cetera, use that type of infrastructure, that type of methodology for validating it. So I guess here's a couple thoughts. These are not necessarily in order, but just a couple thoughts. Maybe we'll put some structure on them as we go to it. Because you said within the next 10 years.
Well, and to provide some background on that, we do have current data from 2018, just several months ago, that shows that there are only 5% of corporate treasurers at the moment who are using or piloting the use of blockchain. So as it stands today, very small numbers of the corporate treasury audience is actively using the technology.
Yeah, and then some of those same surveys and some other ones we do, you see quite a few banks who are pursuing it or piloting, and you see the news reports about how many banks are spending money and investing over $1 billion in some of these blockchain setups. So here's a couple things to think about. If you said Bitcoin in its current configuration, will that be dominant in corporate treasury? No. Will it be dominant on the consumer side? Probably not in its current configuration, because just of trading and moving money in an unmonitored manner, or it's not monitored by any government.
Just an anonymous, yeah.
Yeah, and that's for crime, for terrorism. I mean, many nations have spent significant capital to root out terrorism and money laundering because it's such a big issue. They're not going to give it up and to say that. And you can see news articles. China put some restrictions on that, et cetera. We've also seen quite a few hacks of some of those the organizations that validate, so significant value has left those and had left some of those organizations in peril. So I think there's some challenges there. Now, that's a little bit too extreme if we say, is there any use for Treasury? The idea of, you think about some of the documentary collections. I'm dealing with someone in another country. We're not subject to the right jurisdiction. It makes no sense to do a transaction for $500,000 with them without, a bank, issuing some kind of, documentary collection, LOC for that. Now, that's an expensive process. It can be expensive, very valuable, but to streamline that, offering this in terms of technologically, information go back and forth. There's they can't be repudiated. It's a non-repudiatable transaction. Everyone can see that it's done. You can validate it from the majority of the different entities that track these items. There's a lot of that type of work going on in Treasury, especially as you look internationally. I can see that growing quite rapidly for that type of validation. So I think the answer is we're going to see that take off in some areas, and a 10-year period is long enough. If you said 2 years, I mean, these things take a while. We think, we were talking about EBAM before. It's like everyone's talking about it, and it's very slow growth, takes a long time. We were talking about blockchain and Treasury, 3 years. It might be almost imperceptible in 3 years, but by 10 years, the investments will have come to bear fruit in certain areas. Some things, won't work, and others it'll work well. So I would say, yes, given the areas of particular advantage in Treasury.
So that concludes the questions that we had available for us today.